What's going on, YouTube? Happy Friday. Welcome back to another episode. Accounts at 161,363. So pretty massive drop. And let me show you guys how that looks on the week. We're actually down, what is it, like $12,000 on the week, which is pretty brutal. On the month, we're actually somewhat flat or up 3 grand, which is basically nothing at this point. So we saw an account high for the month at 183.8 back in July 16th. So honestly, last week, so not that long ago, and now we're trading at 161.3, and that's mainly because the MSFT have had one of their worst days ever. So let's look at this chart right here. This is the biggest single day loss this year we've had. They were all down a negative 4.4%, with Tesla having their worst day ever back a couple days ago. Google, Amazon, Meta, and Microsoft are all my biggest positions, and let me show you guys how that looks here on the portfolio. So Amazon and Meta, I have leaps calls on these two, and this represents around $60,000, $65,000 worth of exposure just due to the leverage I have with options. And on the Amazon side, I have around $22,000 worth of exposure. So between these two is around, what is it, 60 plus 20, $80,000, $90,000 worth of exposure with these two contracts. And then I also have $42,000 worth of shares and $40,000 respectively here with Microsoft. So a lot of money in this account is invested into 4 companies. So as you can guess, my portfolio took a big hit this week, and I'm still remain bullish. But today I want to do a deep dive on Google earnings, how I think of the numbers and why I think the company is actually doing super well aside from what the market thinks, and why I think the CapEx spend is justified. We'll talk a little bit more about that. I'll also chat on ServiceNow, talk a little bit more how this company is doing. I have an $8,000 position on ServiceNow. Of course, not as big as the other ones, but it's still a significant bet that I have and that I'm bullish on and might add some more into this. We'll talk a little bit more about that. And we'll talk a little bit more on the MSFT, where I think they're going to head for the rest of the year. Like I mentioned, I'm heavily invested into 4 of these names right here in this list. So this matters a lot for the portfolio. And again, I'll chat a little bit more on Google and why I think this company and why I think everybody's overreacting to it. So let's dive into it. So to get us started, the portfolio is actually looking pretty dire. Like I mentioned a couple of weeks ago, we saw 183, which was really good. And this drawdown is mainly due to Google. I have around $40,000 worth of the stock. Like I mentioned, this is my biggest position, and this was at around $50,000 before the drawdown. We saw 13% drawdowns, and Google gave back all of their gains this year. Let's look at the year-to-date performance. It's actually flat on the year, which is insane. We saw all-time highs of 402 back on May 13th, and me having 134 shares. So they actually beat on revenue by 24%, and they're growing 24% year over year. They had around $80 billion worth of unrealized investment gains with SpaceX. So that's why they had such a high earnings per share. And it was a little bit inflated, like I said, but they beat on revenue, which is great. Their operating income at $40.8 billion. And this is what's spooking most investors in most of the market really with this company. This is the first time that they're going free cash flow negative, and people do not like this. So the big shift now with these software companies like Google, Microsoft, and companies, the MSFT really, is that there were CapEx-like companies. So they would make a ton of cash every quarter and distribute that cash in forms of dividends or reinvestments, share buybacks, whatever it is. But now times are different, and that's because of AI. And I'll chat a little bit more why I think the CapEx is justified. But here's what's going on with them. They're negative $5.9 billion of free cash flow, which is the first time ever they're actually since IPO history. Yeah, they're below zero post IPO. So this is gnarly, guys. This is news for a lot of people here. And that's why the market doesn't like that. And that's why the stock sold off so much. But let's talk about their different segment performances. They had a 17% increase in Google search. That's remaining strong. People are always talking about how Google search is going to get replaced by ChatGPT and Claude or whatever it is. Look at this. They're still increasing. They have $63.3 billion coming just solely from Google search, which is crazy. YouTube advertising, $11.1 billion at a 13% increase. And the one that we love the most is Google Cloud. They had $24.8 billion coming to them last quarter, which is an 82% surge. In the quarter before, they had a 63% surge in Google Cloud revenue. So this is like growing to be a major part of Google's business. And let's talk about their cloud backlog and why they're investing so much money into CapEx. And that's mainly because they have $514 billion of commits from other companies wanting to use Google Cloud, and they just don't have the infrastructure to fulfill on these contracts. And that's why they're spending so much money on CapEx. And let's look at their CapEx right here. So they were guiding to $195 billion, and then they raised it to 205. And so that's the news, guys. They're spending $200 billion on building infrastructure for AI in Google Cloud. And that's because they already have so much money committed to them. So this is what I think of this. I think the CapEx is actually justified, and we're going to see more than $1 trillion amongst the 4 companies I own. And if you want to include Oracle and Tesla in there, SpaceX, for big CapEx spenders, you can as well. And it's a lot of money. Yes, it's a lot of money. It's a fundamental shift on how these companies operate, but it's because AI has become such a large part of how these businesses operate. And companies like Google Cloud, companies like Amazon, Meta, and other players like Microsoft too, with Microsoft Azure, they're all growing their cloud business because there's so much demand for it. They're at a time where they're building for this infrastructure. So people don't like it because they can't see past 12 to 18 months. They just see the negative cash flow number and they're like, oh my God, this company's over. So it's a little bizarre to me. I haven't sold a single share of Google since I bought last March. I have over $20,000 worth of gains. I'm still extremely bullish on this company. I think they're going to be one of the first companies to reach $10 trillion market cap. That's on Google. Let's talk about ServiceNow. This company is a little bit different, a lot of a smaller scale than Google, of course. But let's talk about their numbers. They reached almost $4 billion in revenue, representing a 24% year-over-year increase, which is awesome. Their subscription revenue rose 25% year over year, which is great. Their earnings per share came in at 0.90, which is also over the expectation. Their non-GAAP operating margin was at 29.5%, which was 3% points above the company's prior guidance. I think operating margin is fine. These companies are running pretty efficiently. And again, these are their RPOs, their current remaining performance obligations, hit $13.2 billion, which they're up 21% year over year. This is great news for ServiceNow. Like I mentioned, this company is extremely healthy. I think this is one of the most dominant software companies in the world. And let's talk about their AI services. They actually hit $1 billion on the AI offerings, which is extremely bullish, and they think it's going to hit $1.5 billion by the end of the year. So this company is enabling AI within Fortune 500 companies. They work with more than 85% of Fortune 500. So they're a large player in the software sector, and their infrastructure, their product is great. And that's why they have so much market share. And this is actually a pretty cool stat as well. On their large deals right here, they closed more than 123 deals that were worth more than $1 million in net new logos. So this is really cool. They're up 40% compared. So like, that's extremely bullish. I don't know what people think of ServiceNow, and they think that this company is not healthy, but dude, look at these numbers. Their subscription revenues raised. Their Q3 guidance now, subscription revenue for the upcoming third quarter was guided slightly lighter. So I guess they had somewhat lighter revenue guidance, but they're basically at the 4 billion mark, which was what the market was expecting. And they're trading down on the day, which is crazy. So they're trading back to around $200 a couple of months ago, and they're trading in the 90s. So ServiceNow has been beaten up a lot. I think this company is still extremely profitable, and the company is still pretty undervalued. All of these remaining performance obligations is revenue that they already have tied to them, and they haven't performed on it yet. So if you think about it, they already have $13.2 billion worth of remaining performance obligations for them. So I'm bullish on ServiceNow. The software sector has seen a lot of negative sentiment this last year, but I think ServiceNow is one of the key players on the software sector, and that's why I've bet $8,000 worth of my money on ServiceNow, because I like the company, I like what they do. They're in almost every Fortune 500 company in this world. Anyways, good enough things to talk about ServiceNow. The whole bearish news on this thing is that AI is going to replace ServiceNow. They're going to replace software companies. I think that narrative is just doom and gloom. Like, sure, AI can do a lot, but you can't just build a ServiceNow in your company. As guys, software is complex. All the data that ServiceNow manages, all the data that's different cybersecurity, all these different infrastructure plays, software plays that these companies employ, it's extremely complex, extremely hard to replicate. I don't think ServiceNow is one of those plug and play companies where you can just vibe code away. And unfortunately, companies like ServiceNow and other companies in the market have been beaten up, like Palantir, for example. Zeta Global has been beaten up to a certain degree as well. They think that people are just going to be able to vibe code with AI. Dude, that's not how it works. These companies have a real moat around them. So that's how I feel like people are overreacting to the software sector, and I'm capitalizing on it. The note that these companies are trading down because they're spending a ton of money on CapEx in Meta, Microsoft, and Amazon. All these different companies are going to come out on earnings and guide for higher CapEx numbers, and they're probably going to trade down because that's how the market thinks. But let's listen from the Evercore guy on how he thinks of this.
Numbers keep going up, and so I think there's a little bit of they stop going up and maybe they start going down. It's not like CapEx is going to get cut, but it's going to stop, like it's going to stop growing. But the day that the street consensus estimates largely get it right, and then you don't have to worry about the unknown is how much they're going to invest, but then you can really focus on the ROI, the ROAI. That's the day that these stocks probably, I think there's going to be a huge run in these stocks. The question is when. If you can show these kind of revenue backlog results and then get to that point where you feel like you got line of sight into peak CapEx intensity, then I think that's when the stocks start really working. You've got a headwind here with that investment spend, that CapEx spend. It's a headwind. You need either a very low valuation or you need the outstanding revenue results. I think that creates there's a more positive setup here for a Meta and an Amazon than there is for Google.
Do you have?
Mark Mahaney is basically talking about how these companies are spending a ton of money. They are not necessarily yet finding the ROI from it, but the day they do and they start spending less money or they guide for less CapEx, these stocks are going to start ripping. And at the end of the day, these are companies that have been around for decades. Amazon, Meta, Nvidia, all of these different companies, like they're here to stay. And even if they build all this compute, Meta, for example, has 3.6 billion active users. Think about all this infrastructure they have that they're going to be able to use for themselves and their expansion, but also rent out to different people. And it's going to be really interesting to see what Zuck comes out to say during his press conference. But Mark Mahaney is basically talking about how everybody's so scared that the hyperscalers are spending $1 trillion. And like I said, Google, Amazon, Meta, and Microsoft, which are my 4 biggest positions, they're spending $1 trillion on CapEx next year. And that's basically what they're doing. They have hundreds of billions of dollars of cloud RPOs for the next couple of years, for the next year. So if you think about it, they're already meeting all of that spend. And people are just scared because these companies are investing so much money into the CapEx spend. And at this point, people would just rather buy the semiconductor stocks and the memory stocks that are being the beneficiaries of all this spend. So let's look at this chart right here, which is actually insane. But this is basically a chart here talking about the MSFT and the biggest single day losses here, right? This is 2026. We saw the biggest single day loss a couple of days ago at negative 4.4%. And Tesla had their worst day ever. So that was pretty insane. But this is how that looks. And let me get my face out of the way so you guys can see. So this is what I mean, guys. These companies are getting crushed and the earnings reports are not helping by any stretches of the imagination. But let's look at the yearly performance for these companies. And I'll get my face out of the way here. So we have Apple, we have the MSFT here, and Google just gave back a lot of their gains. And this is, I think, a couple days outdated. But as you can see, a sharp inflection downward. for all of these companies, including Tesla, with probably the most egregious one being minus 28% on the year, which is insane. And Amazon trading flat, Google, again, giving back all their gains, Nvidia and Apple kind of hanging there. But that's how I think, guys, of the Max 7 and the recap for the week. Again, these companies are trading down on fears that spend is not slowing down, that free cash flow for Google, and I'm sure Microsoft and Meta are going to come down with the same numbers or similar numbers, guiding higher CapEx spend for 2027, and free cash flows are going to be decreasing. And at the end of the day, guys, this is just what's going on right now. You have to look 3 to 5 years, 10 years in the future. You got to be a long-term investor. I know it's a meme at this point. People just justify their losses thinking that they're long-term investors, but you have to think to buy quality companies. And if you're willing to buy more when they're trading down, that's when you know that you have a solid company in your hands, if they have a justifiable valuation as well, and a lot more that we can dive into. But this is where the portfolio is sitting, and I plan on adding some more into, I think, Amazon or maybe even Meta, because these are my lighter positions. But this is the recap for the week. Everything's trading down. Portfolio is down more than $20,000, which is pretty insane. But I'm still extremely bullish on these companies, and I explained to you guys why. I appreciate you guys being here today. Let me know in the comments what you think of this video. Don't forget to leave a like and subscribe. I'll talk to you guys soon.